Very good afternoon to all of you. I, Sanjib Pattnaik, welcome you to our sessions for the course on Management Control System, and it has been coded as MMPF 003. Already, we have covered up much of the course, and today, in this last block, that is how management control is exercised or application of management control, the techniques, the practice in some special organization we shall be looking at. When we looked at management control in some special organization, in the last session we started with, we focused on various financial institutions, and particularly the focus was in Indian economy. We started with banks. We looked at financial institutions like mutual funds, the insurance companies, and also we had a look at the non-profit organizations. Now, what are their characteristics? How management control is exercised there? What are the challenges faced by this kind of organization? That we have discussed in Unit 13, 1.3. Today, when we shall look at application of management control in some special organizations, we shall focus on the multinational and export organizations. Uh, Before anything, uh, I'll tell that in the Indian economy, almost all of us might have gone to some kind of supermarkets. Suppose the supermarkets, a particular section is assigned to various kind of juices. If we visit there, or as we might have seen there, we might have seen the packaged juices not only from the companies of Indian origin made in India, but also the packaged juices from the other countries. They are brought into our country and they are sold here. Now, that other country has exported the packed juices and we have imported that because there is a certain kind of demand in our economy regarding those type of products. Now we can think of thousands of such kind of examples where imports and exports come into the picture. When we are talking of importing, then we are talking of getting the items from an outside country. If we are talking about, suppose India, uh, we have abundance of iron ores which are used in manufacturing of iron and steel. So there what will be happening? We have seen India is a large exporter of iron ores. Similarly, India is also a large importer of petroleum or the crude petroleum because the demand for petroleum in India is very high and it is not available in India easily. A small portion, very small portion of our demand is satisfied from the local petroleum, that means the offshore mines or the offshore wells that we have in India. But more than 90% of them are imported from the Gulf countries or maybe Russia. So every country faces a situation where it either exports some kind of goods for which it has large volume of production, and after catering to the local needs it helps country to satisfy their needs where the demand for those kind of products are there. Similarly, the host country or suppose India is also in need of many items which we are not able to have it here or manufacture it ourselves. So what happens there? We try to get it from outside countries where they are available in plenty. Now, these companies which deal with the uh, exchange of products or services, you may also take between countries, they are called the export and import organizations or multinational organizations. So our focus today will be on those kind of companies. Now let us get introduced to them. Uh, During the past 3.5 decades, there has been a rapid internationalization of business. What has happened in the last uh, 35, 35 years? Now, India has opened up its borders for business with other country. For the policy it adopted around 30-35 years back called as LPG, liberalization, privatization and globalization. So our business, they could send the goods to outside. Our requirement could be fulfilled by companies from outside countries. Outside companies can set up industries here, or we can set up industries outside also. And this has seen a rapid growth in this last 3.5 decades. All of us might have seen nowadays any product you think of which is available globally is also available in India. Now, Indian products are available also in the global context. That means in other countries. Now, here we have three type of description for the international businesses. One is global corporation, another is the multinational corporation, and the third one is the international corporation. Suppose we have a scale, then at the two extreme ends, we will be having the global corporation at one end and multinational corporation at the other extreme end. That means the two extreme end points represent the global corporation and multinational corporation. That means they totally differ from each other. And somewhat in between, having characteristic of both the global corporation and multinational corporation, comes the international corporation. Now, let us see, even though many of us say that global, multinational, international corporations, the terminologies are same, but no. If we look at them carefully, minutely, then we'll find there is some difference between the three things. Let us look at global corporation. What is global corporation? Now think of a company which produces certain product at few location located at particular places. That means it has centralized production facilities. The production is of very high volume so that economies of scale, that means volume is very high so that thereby we have the cost minimization can be achieved. So global corporations have central production facilities. They will be having either the production facility in a single country or in a few countries. Now whatever are the production from there, they will be taken and supplied to those countries where the products are of demand. So here, this, as we said, in order to achieve the economies of scale, the volume of production is very high and they have a guarded technology. When they have a few manufacturing facilities or production facilities, that means they do not want to divulge their technological know-how. They want to keep it with them. Similarly, it also avoids nationalization of industry. What we mean by nationalization of industry? Now suppose we are a company belonging to India. We have set up a production facility in certain other nation. Now, due to some kind of situation, maybe political, maybe due to other issues, the authority over there, they will tell that the company will be taken over by their government. So it poses a threat to the company. So in order to avoid that kind of scenario, the Indian company will set up few production facility or very minimum production facilities in the countries where such kind of nationalization threat will not be there. So what we find here in global corporation, the production facilities are set up in very few places or very few countries where the chances of nationalization is not there. The volume of production is high and they try to achieve the economies of scale. And from those production facility, they cater to a large number of other countries where the products are demanded. Now let us look at the other extreme, multinational corporation. In global corporation, we had centralized production facility. But in multinational corporation, the company will be having its subsidiaries or production facilities in every country where it is operating or in every locality where it is operating. So we say it is localized production facility. So number of production facility will be very high according to the number of countries where they are operating. Now, why this happens? Now, in order to avoid the regulatory export-import barriers. Many times what is seen that countries try to put barriers either for importing the items by a company in their country or for exporting the products out of their country by putting suppose higher custom charges or tariffs, etc. So when a company faces such kind of regulatory export import barriers, it goes for localized production facilities. That means the impact of the export import barriers which would have been felt if it would have been a global corporation would be reduced. Now, these multinational corporations also come forward or are set up by the parent company in order to avoid the high custom duty or the high transportation cost. Now, if we have localized production facilities, there is no need of transporting the items to a particular country which may be very far off. So you can produce in your own production facilities inside the country and the transportation cost will be minimum. Now, in between the two, having characteristics of both global corporation and multinational corporation, we have international corporation. For example, global corporation, we can take the example of many automobile manufacturing. You will find automobile manufacturing, whatever is the country they have started with or set up for the first time. Apart from that, they will be having their production facility in few other countries, not all the countries, and they will be exporting from the production facility the vehicles to the countries where they are needed. We can take the example of Maruti Suzuki Limited. It was manufactured mostly in India, or it is manufactured in India, whichever country had demand for Maruti cars, the cars were exported to those countries. So the Maruti Suzuki became a global corporation. Now look at a food chain called as KFC. Now if you would say that I will only have the production facility in few countries, the products of the eatables of KFC company, uh, the transportation cost will be very high. The maintenance cost will be very high also. In order to avoid that, if we have localized KFC centers as subsidiaries of the host company, that means the parent company, then what will happen? KFC can uh, have the inputs from the local areas, the outputs, it can take the local taste, and the chances of the expiry or maintenance is also low, along with very low transportation cost. So global corporation and multinational corporation, they vary in their characteristics. But many times we use the words global, multinational, international in the same way. Now, when we are looking at the export and import businesses, what are the kind of situations that we face? That means we as a multinational company or export company, what are the things we are facing? First is the culture. Now, you can say that uh, think of a company, the KFC. When it came to India, its production is mostly focused on chickens, or McDonald also, or any eatable company of American origin or American parent. They focused on what? The chickens in non-veg section. But in countries, that means European countries, the American nation, or the countries having higher Muslim population, they were having the outlets which were catering mainly beefs along with chickens. So here the local culture is coming to the forefront. So every nation might be having some kind of preferences for the items. Similarly, the population may also have preference and reactions to management control, and this would be varying from country to country. Now you can think of workforce and their demands, how they do it in India or how it is done in case of Japan. So people of different nationality have different preferences for and reactions to management control. So the culture, we can say, is the mindset of a group of people, or the group of people living inside a national boundary or the majority thought process of the population of a nation. So, when we talk of differences across countries, then the first thing that comes into picture is the culture. Now, what are the dimensions of culture? And accordingly, what kind of management control we will be taking? The first dimension we talk about is individualism. Now we have two things. Either we can think for ourselves, that is I, or we can think of the group which we are belonging, that is represented by we. In many cultures, I is important. What I do is important. What I achieve is important. But in some other cultures, we may find the opposite. People work so that there will be a combined result for the total population. That means all the population will be uh, having some kind of gain out of that. So, wherever or in a country, wherever you are having the I individualism, there the management control can be exercised through the personal incentives, personal rewards, personal promotions, etc. That means the focus of incentives and rewards will be towards the particular individual. When we think of a country where the cultural dimensions is based on we, then the management control can be exercised in the form of group rewards or group incentives or the group benefits, etc. The second cultural dimension we can take into account is the power distance. Now, we have two things here. One is in an organization, there is the top level management. The second part or the other part is the workers. So the management and the workers are the two things. Usually the management have the power or exercise power in order to get the things done. In some countries, we may find the people or the workforce are not interested in the decision making process. That means they have a distance from the power corridor or the decision making corridor. So there we can say we can have centralized organizations. That means the centralized organization, the top management or the management will be having all kind of decision making powers. Think of the other way around. In many countries, we may find the workers also want a participative decision making process. That means the decision making process is not only the only can be exercised by the management, but also it has to be done along with the workers. That means the workers here are a part and parcel of the decision making process. So we say that here we can have decentralized organization. That means the decision making process is distributed among the employees of the organization instead of holding it back with the management only, as we found in the centralized organization. Now, the third cultural dimension we can look at is the uncertainty distance. That, in other words, what is the future of present action? Uh, Suppose we are taking a decision, processing the decision into generation of outputs, that is in form of products and services. Now those outputs or the resultants, the benefits or the negative benefits will accrue in the future period of time. We act today, but the results will come in the future. In many countries, the workforce is risk averse. That means they do not want to take the risk of uncertain future. In other words, they want to be assured of the results that is going to accrue in the future period of time due to their present actions. But in some other countries, the workforce, they are not concerned about uncertain distance. We can give them any kind of tasks. So instead of thinking the future of the task, they will go on doing it. Whether it is bringing good result or bad result in the future, they are not worried about. The fourth cultural dimensions we can think about is masculinity. So the term masculinity, when it comes in front of us, we think of a person having grace, having skills, having decision making capacity, and has climbed the stairs or the ladders of the work culture. In other words, the masculinity is based on achievement, assertiveness, and success. We saw the differences across countries, that means the cultural dimensions. Now let us see regarding the institutions. We may find the institutions which run a particular country will be differing from country to country. When we say institutions, we are talking about the government agencies, corporate affairs, the banking system, the labor unions, the regulatory agencies, the insurance companies, etc. Government agencies, that means law enforcement, you can have law adherence through corporate affairs, the successful running of the economy by banking system, betterment of the workforce and their life by labor union, regulatory agencies to keep a check on the unethical practices, insurance companies to safeguard the organization from the future uncertainties. So these institutions will vary from country to country. So while designing an MCS, some of the things that we focus on is shape of labor law and unions. In some country, we may find the labor unions are very strong, and in some countries the labor unions, they do not try to be assertive. So when labor unions are very strong, they make demands, and sometimes unreasonable demands also, that may pose a threat to the company. The various kind of labor laws prevailing in a country also adds to the shaping of the management control system. Now, when we set up company or subsidiary in a foreign country or other country, when I say other country, that means outside India, let us think. Many times we need the financial resources which can come from the financial markets. In many countries, the financial markets are yet to be fully developed, like developing nations. So there, the stock exchange, etc., may not be that developed. The stock prices may not reflect the true scenario of demand and supply. And sometimes the subsidiary companies, government, will be having laws that some proportion has to be owned by the local population. So we have to look at the prevailing financial markets, the kind of regulations through which we can generate funds in the subsidiary country, etc. Another important thing is when we are talking of multinational and export organizations, suppose we are dealing with a host country and a subsidiary country, then the accounting standards in the host country may be different from the accounting standards practiced in the subsidiary company. So this may lead to the differences in the calculation of the profits, the calculation of the depreciation, etc. So for that, we try to adopt the gap, generally accepted accounting principles. That means the uniform accounting standards across the countries. So if the host country and the subsidiary country are having the generally accepted accounting practices, then it is very easy to match the balance sheets of the subsidiary companies with the parent company. Now, we are looking at differences across countries. We looked at the culture. We looked at the institutions prevailing over there. The third difference that we can look at is the business environment which is prevailing. The first thing is the risk and the uncertainty. Now, before starting anything under risk and uncertainty, many of us are of the view that both risk and uncertainty mean the same thing. Now, it is not always the same thing. For example, in simple terms, let me try to tell. In monsoon season, suppose I start for my office and I travel to my office by scooter. So in monsoon, there are every chances that there may be rain at any given point of time. So one day, what I have done, I have left my raincoat at house and I have started by scooter. So there, I am carrying a risk that it is rainy season, I may get wet if it rains. Now, if it rains, I get wet, then it is a bad thing for me, a bad result for me. If it doesn't rains and I get to the office without getting wet, then it is a good result. Now, going to office or starting from my office to reach the office is a future activity. Now, the future activity has two kind of consequences: good result and bad result. Good result is getting wet, but bad result is not getting wet. So when we are having more than one kind of options or results which may occur in the future course of time, we say that it is uncertainty. Now, this uncertainty has a good part associated with it, a bad part associated with it. The bad part associated with the uncertainty is the risk. If I get wet, then it is the risk. So risk and uncertainty differs from the business environment prevailing in countries or across countries. Why this risk and uncertainty arises? One can be due to tax rates. In many countries, the tax rates are very high. That means the income or the profit that is being generated by the corporation or the subsidiary, the tax will be applied by the local government. Now, this tax rates may differ from country to country. Sometimes the tax rates also change. Now, this changing tax rates, if we have to pay more taxes, then it poses us the risk. Second kind of risk that we face is the export-import policies. We know that the policies of a business environment in a country is decided by its government. Now, in developing nation or underdeveloped nations, these policies do not have any kind of logic behind it. These policies may be taken whimsically. So once the country is moving towards the developed area, then the export-import policies, they try to even out and they give a common or level playground to the organizations or the multinational organizations to have global competitiveness. Another risk we can face is pricing restrictions. Sometimes the organizations, either it may be the subsidiaries, the country where it is operating, suppose it is having a control regime, that means the prices will be fixed by government. So here we do not get a fair price for our outputs. Another risk we may face is the governments many a times try to channelize resources towards priority areas of their country. They may ask that you can set up industry in this particular sector. They may ask that workforce of this kind in belonging to our country will be appointed in your company. They may ask also the raw materials or the fund requirements will be taken in this particular policy. So, according to the subsidiary countries' policies, the resources of the subsidiary has to be channelized towards the priority areas. Now, business environment, apart from risk and uncertainty, also has a thing called as inflation. So all of us have heard or used the term inflation. Inflation, we can say, is the devaluation of rupees or the monetary units. That means, suppose earlier we were able to get certain item for rupees 100 and we go to the market today, we'll be finding that due to the rise in the price of the items, the number of or the quantity of items brought with the same number of monetary units will be less. That means the value of the monetary units has come down. The purchasing power of the monetary units has come down. So the inflation rates may be varying across the subsidiary countries and the host country. Another aspect of business environment is labor availability and quality. It is not always that wherever we set up subsidiary, we can find labors of required skill, knowledge, and experience in the host country, in the subsidiary country. So we have to train them, or we may have to get them from other countries, provided it is permitted by the subsidiary country's government. Another thing or aspect of business environment is labor mobility. In earlier days, what was happening? Once we get a job, in India also we have seen, once we get a job, then we stick with it till we retire from that. It was not easy for hiring or firing an employee. But nowadays what has happened? Today we may get employment. Tomorrow if we are not performing, then we may receive a firing notice from the company and we move to another company, maybe at another location. So labor mobility has become common nowadays. Now here, when we try to transfer the various items from subsidiary to another subsidiary, maybe in another country, or maybe to the parent country, what is the kind of transfer pricing that has to be exercised? What are the things affecting it? First is taxation. The tax rates in the host country and the subsidiary company will be different. There may be different kind of regulations for taking out the outputs from a subsidiary country to another country. There can be different rate of tariffs. That means the customs duties, etc. in different countries. Many countries also have foreign exchange controls, and they also try to provide regulations on how much profits can be transferred to the parent company or how much can be kept with the subsidiary. And if there is a joint venture, then how much will be the sharing of profits between the joint companies. Now, the methods of transfer pricing can be three types. One is the market price method. That means if we sell the outputs of a subsidiary company in the open market after making necessary adjustment for tax, inflation, etc., without any kind of controls, that is called as the market price method. Sometimes what happens, outputs of one subsidiary may be becoming the outputs the inputs of another subsidiary. Now, what is the transfer pricing there? Now, instead of transferring it to the subsidiary company of the same parent company, if one subsidiary company could have sold the items to the subsidiary company and the other subsidiary company at whatever price it will be selling to the outside without control. That means it will be reselling. Then it is called as resell price method. The third method that is also adopted or can be adopted is whatever is the cost in order to produce the outputs plus some markup. That means percentage of profits will be added and we will get the transfer price. Now, when we are talking of dealing between countries, the most important factor that comes into picture is the exchange rate and what are the implications of management control. Now, what is that exchange rate? If anybody has gone to some other countries, we might have seen that before traveling abroad, we would have changed Indian rupees into certain other countries. That means the country where we are visiting, or to a currency which will be accepted by the other country where we are visiting. So, mostly US dollar, the euro, etc. are few of the currencies which are readily accepted in most of the countries. Indian rupees is accepted, but in few countries. But if we change our rupees to monetary units in terms of dollars or euros, we can take them to any country and we can change them to currency of their country. Now, these exchange rates, what are the terminologies associated? If we look at the paper, we may find certain word rupees 80 per dollar. That means US dollar. What we understand? That if I pay 80 rupees to a money exchanger, it may be a bank or private money exchanger approved by government. If I pay rupees 80, then I will get $1, 1 US dollar. So it is called as a direct quote. How much I pay for 1 unit of a foreign country's currency in terms of our home country currency. So for $1, I am paying home country rupees 80, direct quote. If we change it the other way around, it becomes the indirect quote. That means how much dollar I will get for 1 unit of currency of my home country. In other words, for 1 rupees, how much dollars I will be getting. Now the same direct quote, if we change it, it turns out to be $0.0125 for 1 rupee I will be getting. Apart from that, if we go to banks or money exchange companies, we may have two rates, buying rate and selling rate. If I go to a bank, I need some US dollars because I want to go to another country. The bank will give me a quote, suppose rupees 75 per dollar. That means I have to pay 75 rupees for each dollar that I am purchasing. Similarly, when I come back, I find certain dollars are left with me. I'll try to change that with the bank. So when I take it to bank, the bank will now buy it. So it may quote that for each dollar it will be paying us 70 rupees. So banks, some bank branches offer this facility of buying and selling. Similarly, we have nominal exchange rate. Now, it is the spot exchange rate. That means as on today at this point of time, if I go and purchase a foreign currency, how much I have to pay is called as the nominal exchange rate. When we try to adjust the inflation rate to the spot exchange rate, then it becomes real exchange rate. Now, many times what happens? We try to enter into contracts where we try to buy the foreign exchange in a future period of time called as forward exchange rate, which can be at discount or premium. Discount means at lower than today's value. Premium means higher than today's value. If it is at par, that means the same value as of today. One example is here. During the last year, $1 was 70 rupees, and during this year, the inflation rate in US was 5% and in India was 8%. The spot rate today is 72.5. What are the implications on a business? Now, what is the interest inflation differential? Now, it is 8 minus 5, that is equal to 3%. What is the real exchange rate? That is 72.10. So the spot rate of rupees 72.5 per dollar, the value of rupees has depreciated by 72.5. That means today's spot rate minus 1 year back it was 70, that is 3.57%. So goods made in India and priced in US have become 3.57 cheaper. So if we are having higher depreciation in our host country, goods become cheaper in the country where we are selling it. We can have different types of exchange rate exposure. One is translational, that means which is due to changes in the spot exchange rates. Transaction exposure due to whatever we pay or receive in the other country, or economic exposure which is due to changes in real exchange rates. So when you are designing control system, the manager should not be held responsible for translational effects. And also the transaction exposure is to be handled by parent companies. And any economic exposure, subsidiary managers should be responsible. So with this, we shall be ending our session. Thank you.